Hi guys. Today we will analyze Shell stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock is a good performer in the overall market. Both the short-term and long-term trends are positive. Strong support levels are around $56 and $52.50. Next strong support levels are around $49.50, $44.50 and $42. Strong resistance level is around $60.70. In the last month the stock has been trading between $52.30 and $60.70 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 5.2 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 9% per year, for last 5 years. We see that the average profit margin of the stock has been around 2% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 83% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Shell Company: bad, average, and good. First scenario. Shell will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, -3%. Future profit margin would be a low, 2%. Future free cash flow to net income rate would be a low, 70%. In this case, the fair value of the stock today would be $32. Second scenario. Shell will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 0%. Future profit margin would be average, 3%. Future free cash flow to net income rate would be average, 75%. In this case, the fair value of the stock today would be $48. Third scenario. Shell will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 3%. Future profit margin would be high, 4%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $71. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.58. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Shell, analysts forecast growth rate around -3% per year in next 5 years, and future P/E around 7. Again, I will use 3 different scenarios for Shell Company: bad, average, and good. First scenario. Shell will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, -3%. Future P/E would be a low, 8. In this case, the fair value of the stock today would be $14. Second scenario. Shell will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 0%. Future P/E would be average, 11. In this case, the fair value of the stock today would be $26. Third scenario. Shell will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 3%. Future PE would be high, 14. In this case, the fair value of the stock today would be $43. As you can see, today the stock is overvalued, $60, even if we expect the company's high performance in future. Both the profitability and the financial health of Shell get a neutral evaluation. Nothing too spectacular is happening here. And the revenue is expected to decrease by -3 to 5% on average over the next 5 years. Based on that, the stock looks overpriced at the moment. I may consider buying the stock when the stock drops to $45. Company's strengths. Shell plc is a British multinational oil and gas company. It's one of the largest companies in the world by revenue and profits. Shell is vertically integrated, and is active in every area of the oil and gas industry, including exploration, production, distribution, marketing and other. It has operations in over 99 countries, and has around 44,000 gas stations worldwide. Shell possesses strategically located reserves, precisely where demand is growing the fastest, and where it is least likely to come under regulatory pressure to shift operations. Shell's liquefied natural gas business will play a critical role in ensuring energy security for Europe. Significant investments by Shell will allow it to become a prominent player in a carbon-neutral world. Shell's energy transition strategy differs slightly from peers in that it is pursuing a low capital intensity business managing power needs for customers, as opposed to investing in renewable power generation capacity. Shell is still generating huge amounts of cash. Gradual increase of dividend and generous buyback should reward patient investors. Shell has a return on assets of 5.2%. This is comparable to the industry average of 3.7%. Its profit margin of 8% is in line with the rest of the industry. The industry average profit margin is 12%. Risks. The company is exposed to volatile, cyclical, and capital-intensive segments of the energy sector. Investors in Shell shares are exposed to numerous risks, including trends in energy prices, interest rates, and global economic growth. Shell also operates in some countries with a history of official corruption, and in others that are prone to political upheavals. Following the invasion of Ukraine by Russia, Shell announced its intent to withdraw from its ventures in Russia with Gazprom and related entities, and to end its involvement in the Nord Stream 2 pipeline project. Shell's large liquefied natural gas position puts it at risk, if renewable power generation grows faster than expected, or intermittency issues are solved, meaning natural gas will no longer be needed as a bridge fuel. Changes in policy related to climate change, such as a carbon tax that could result in higher costs, reduced demand, or stranded resources. Operating in offshore environments exposes Shell to the risk of large oil spills that could result in material losses through lost revenue, fines or penalties, or loss of license to operate. The dividend cut in 2020 leaves its current cash yield lower than peers. Shell has a return on equity of 12%. This is below the industry average of 17.6%. The company is expected to show a decrease in revenue. In the coming 5 years, the revenue will decrease by -3 to 5% yearly. The earnings per share is expected to grow by 5 to 8% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.